look at Chapter 11 of the Walker textbook. And again, it's always a good idea to be following along with the textbook and maybe jotting down some notes in addition to what you're seeing on the screen or what you see in the notes. And also make sure you're reading the textbook and reading and following along, especially as we do this virtually, at least for the time being. We're going to be looking the rest of the semester at investing, how to build a portfolio, how to plan for life, why should you invest? And we'll look at specific types of investments over the next few days and weeks. But right now, we're just going to look at why you invest and why it's important to begin setting aside money. And one thing we've talked about since the beginning of the semester is saving. Saving at least 10% of your money whenever it comes in. However much you make, if you make $10, save $1. If you make 100, save $10. If you make 1,000, save $100. And that's your foundation. That's your start. And when we look at savings, that is just the plural of saving. The money you set aside ends up being put back into the financial system, which we learned about a little bit last semester. But when we look at it from our personal perspective, we're looking at a savings account, a certificate of deposit, a money market account, something that is FDIC insured, that you're guaranteed to receive your principal. This is where you should be keeping your emergency fund. For right now, that's probably where you're going to put all 10% of that 10% you're setting aside. So 100% of the 10% right now you'll put into savings and build up that emergency fund. Once that emergency fund is built up, then you want to think about different types of investments, because what investments do is they allow you to let your money grow. And one thing, if you remember back to earlier in the semester when we looked at the time value of money and how money grows exponentially over time because of compounding and compound interest, this is where you take that compound interest and make it work for you. But start with your savings. A savings account or a certificate of deposit. You're going to start with a savings account right now while you're in high school, while you're probably in college. You're probably not going to be looking at anything beyond a savings account, and that is perfectly okay. A savings account is important because it allows you to accumulate money for things that are short term. Obviously, at the time we're recording this, there's a lot of life shutting down right now, and a lot of people, especially if they're hourly workers, may be out of work for the time being. They need to rely on that emergency fund because they may be without a paycheck for 1 or 2 pay cycles. And that obviously is a significant hardship. So having that emergency fund is key. We've talked about that all semester, making sure that you've got a little bit set aside because accidents happen. You may miss a paycheck. You may have to go to the hospital. You may have an accident. Something may happen. You're going to have bills and unexpected bills. And so having that emergency fund is vital to make sure you have a little bit of money that is left over. And there's a saying in your book that says savings is not to make you rich, but to keep you from being poor. And that's really the key, is to prevent surprise expenses from really harming you and to allow you to be prepared for that. And one thing John Wooden often said is we want to plan for success, but we want to prepare for failure. You got to prepare for that unexpected thing that's not going to go quite right and have a plan for how you're going to deal with that. And having money in the bank is always key. What you want to do with your emergency fund, first things first, build up a month of salary. But then after that, try to have 3 to 6 months income saved. So start out with a month, then get it to $1,000, then try to save up 3 to 6 months of your income and have that set aside. And obviously, if you're setting aside 10%, it's going to take a little bit of time to get 3 months income. 30 months to be exact will get you 3 months income. But if you do it little by little, you'll eventually have that built up. And then you work on getting to 6 months of income and constantly replenishing that emergency fund. Here's the key thing with savings. You're not going to make a whole lot of money off of it, and that's just reality. Interest rates tend to be low, and the reason why is because those investments are safe. Your savings account is safe. A certificate of deposit is safe. Why? Because it's backed by the FDIC. If your bank goes under, every single dollar that you have in that account is going to be replaced. And so savings is where you kind of keep your emergency fund, where you keep the stash of money you need to have readily available. Investing is something you do for the future to try to build wealth. Yes, there's risk with investing that you don't get with savings, but you gain returns that outpace inflation. One thing your savings account won't do, or your CDs won't do, is keep up with inflation. So actually, you're losing money in the long term in a savings account. In an investment account, that money usually outpaces inflation, but there is risk involved. The greater the risk you take, the greater the potential return you may get, but also the greater the risk of losing your money. And so you have to be a little bit careful with investing. And so understand that with investing, obviously what you're hoping to do is profit, but there is going to be a risk that you may lose what you put in. And so there is something we refer to as a risk premium. The buyer of an investment is going to take some compensation for taking a risk, such as the premium for investing in a small business. You're going to pay a little bit more to get somebody to take a risk if you are the one who is borrowing that money. And if you're selling a bond or if you're selling stock, you're going to pay a little bit of a premium to get somebody to loan you that money. And a lot of times we call that premium interest. And interest, again, compounds. And so over the next few weeks, we're going to be looking at a lot of different types of investments. And so we're going to start here by looking at the risk-return relationship. There is a positive correlation between risk and return. The greater risk you take, the higher the potential return. And go back to the example we used earlier with Perfect Polly versus Uncle Eddie. We were thinking of it from the borrower's perspective earlier, that Perfect Polly is going to be able to shop between lots of different people who will loan her money, and therefore she's going to get a lower interest rate, whereas Crazy Uncle Eddie is not. He's going to have to pay a high interest rate because nobody's going to loan him money because of the fact that he knows, or they know, that that money's probably never going to come back. Uncle Eddie is a risk, so he's going to have to pay a higher insurance rate, or interest rate. That's what we call the risk premium. And so understand there's a positive relationship between risk and return. The greater risk you take, the greater likelihood that that money's never going to come back. You loan money to Uncle Eddie, there's a greater likelihood it's not going to come back. But there's also a greater likelihood that if it does come back, you're going to make some bank. You're going to make a good return off of that. And so the greater risk, the greater the amount of potential return. There's one other thing that leads to the amount of return, and that is time, or what we call liquidity. The more liquid your investments, in other words, the faster they can be turned into cash. Think of water. Remember, water is liquid. You can drink it. If it's ice, you've got to wait for it to melt. And so think of liquid investments as water. They can be turned into cash right away. Think of non-liquid investments, things like real estate or bonds, as ice. You've got to wait for them to mature, or you've got to wait to some unspecified point, or in some cases a specified point in the future, before you can touch that money. And essentially, it's like waiting for ice to melt. And so the longer the time period, the longer you have to wait for the ice to melt, the higher the interest rate, or the higher the rate of return you're going to get, or you're likely to get on that investment. So the book talks about several different types of risk. And so I want to kind of list these here because, again, each level of risk leads to a greater return. One of them is, and probably the biggest type of risk, is the default risk. It's also called the credit risk, which is the risk the company you have invested in may declare bankruptcy. So if you buy a corporate bond in, say, an auto company, this happened with General Motors several years ago. People back in the 50s and 60s and 70s buying bonds in General Motors, loaning General Motors money was basically a license to print money. And then what happened? General Motors didn't survive the recession of 2007 to 2009. They declared bankruptcy. Well, when you're bankrupt, you're essentially declaring that you can't pay back your debts, and a bond is a loan to a company. So suddenly, this company can't pay back its debts. It's those bondholders now are not getting paid back. So there is a risk of default. And so where there is greater risk of default, the interest rate is going to be higher. That's why government bonds usually pay very low interest rates compared to corporate bonds, because the risk of default is lower. The government is not going to declare bankruptcy, especially because the government controls the printing press. It can always increase the money supply to deal with a credit crisis, whereas a private company cannot do that. One of them is the interest rate risk. And this is one of those things you look at, especially with longer investments. And so when you lock into a fixed rate investment, in other words, say you buy a bond that pays 2%. Well, over time, let's say the rate of inflation goes above 2%. Well, now that bond that you were expecting to pay, say 1% over the rate of inflation, now is paying below the rate of inflation. So that is something that you run into. And over time, if the inflation rate goes up, obviously investment prices are going to go up too. So bond rates will go up to 3 or 4% if the inflation rate goes up to, say, 2.5%. And so you lock yourself into a long-term investment at a lower interest rate, and that suddenly makes those bonds much less valuable than they otherwise would be. And so understand that there's interest rate risk whenever you buy a long-term investment. You run the risk that interest rates are going to go up and you're going to be locked into something with a low interest rate, which means that you're going to be locked into something that will have very little value. Now, there is an inverse relationship between bond prices and interest rates. We'll look at that much more in depth when we get into the bonds chapter after spring break. There's a market risk. There's the risk that an investment's value will decrease due to changes in the market. So, for example, real estate has a significant exposure to market risk. And what we mean by that is that, let's say you buy a house and you spend $150,000 on that house, and then there's an oversupply of housing, and as a result, the price of housing drops and that house is now only worth $100,000. That's market risk. You're running the risk that the market value of that asset is going to go down. It does happen sometimes in real estate. It happens a lot in stocks. Stocks and some really high-level things like commodities and especially foreign currencies, they have significant market risk. And as a result, you can get a lot of money out of these if you're willing to take on that risk. You're running the risk that the value is going to go down. And that's one thing. If you look at the stock market right now here in 2020, the stock market's been plunging. The value of stocks are going down. And so if you buy a stock today and it goes down tomorrow, that's market risk. You're running the risk that the value of your investments may drop. But what you're hoping is when you invest, you're thinking long-term, not short-term. So when you look at the market, yes, it may be plunging now. It may be plunging over the next week. But 10 years from now, the general trend is up. And so you're expecting that market risk may be short-term, but generally the long-term trend is up. And the same thing with real estate. You may have an area where there's oversupply and therefore the trend is down, but overall the trend for real estate values is that they go up. And so inflation risk, the risk that the value of an asset will decrease over time due to inflation because inflation will eat away at that. And so one thing you want to look at is the relationship between the interest rate and the inflation rate. If the interest rate or the rate of return or the yield is higher than the inflation rate, you're going to make money. And if it's lower than the inflation rate, you're obviously going to be losing money long term when you think of the real value of that asset. And again, remember back to first semester, the real value of an asset is basically the interest rate you receive on that minus the rate of inflation. So if we have 2% inflation and you have a bond that pays 4% interest, over the long term, the real value of that bond is 2% because it's outpacing inflation by 2%. Finally, liquidity risk, the risk that you can't get cash out of an investment quickly enough. Obviously, if you're holding a 30-year bond, you got to wait for 30 years till that bond matures, but understand that you might be able to sell that bond on the secondary market. And so while there is risk, you may not be able to sell it right away. You're hoping to be able to sell it, whereas a stock, you can sell that right away. However, you may not be able to sell it at the price you want to. So there's less liquidity risk with stock, but there's greater market risk. With a bond, there's less market risk. Bonds generally hold their value, but there's greater liquidity risk. With real estate, again, the trend is up. So there's some market risk, but generally the risk with real estate is liquidity. You're not going to be able to sell it quickly enough, maybe, to get the cash you need when you need it. So one thing you have to figure out is your risk tolerance. How much can you afford to lose? And if you take a look back at worksheet 11.1, at the back of your chapter, you'll be able to see your level of risk tolerance and kind of be able to do that. We'll take a look at that later on. The investment pyramid, then, the key to investing is diversification. And that's going to be really the key thing that we'll talk about throughout the semester is diversifying. You want to have lots of different types of investments. You want a little bit of money in stocks. You want a little bit of money in bonds. You want a little bit of money in real estate. But the nice thing you can do is you can diversify. And one way you can do that is something we'll look at next week, which is the mutual fund, which is where you can pool your money with others, buy a bunch of stocks and bonds and real estate and other things, and therefore be able to get that level of diversity without having to have a ton of market knowledge or without having to have a ton of cash to invest in a bunch of different things. The critical thing, though, is diversification. And generally, you want to go high enough on the pyramid, and there's a good example of the pyramid on page 288 in your book. You want to go high enough on the pyramid to where you feel comfortable. Most of us are comfortable going up to about tier 2. I would not advise going to tier 3 unless you are an absolute financial savant. And most people aren't. So stick with what you're comfortable with. The base is savings. Those are no-risk investments like your savings account. That is not investing. That's your savings account and a few things like that. Maybe U.S. Treasury bonds, a checking account, certificates of deposit, things like that. And so government bonds, which pay fairly low interest, savings accounts, which are very liquid but pay very, very low interest, that's your base. That's where you have your emergency fund and maybe your safe investments that you have just to make sure that you've got some principal, you've got some amount of money you need when you need it. Tier 1 is fairly low-risk investments. And again, low risk means lower return. So what are we looking at? Money market accounts. Again, that's kind of a savings account, but pays a little bit higher interest. It's still going to be a little bit below the rate of inflation. Fixed income mutual funds, higher grade corporate bonds, highly rated corporate bonds. These are companies that are really under no threat to go bankrupt at all. Obviously, the interest rates on those are going to be really low. Municipal bonds, again, most cities and towns and school districts are not going to go bankrupt. The one advantage of municipal bonds is they're tax-free. You don't have to pay income taxes on your muni bonds, so they're fairly low risk. Go up to tier 2, and you're looking at your intermediate risk. So you're looking at growth stocks. These are still relatively safe, but there is some risk. There's some market risk in growth stocks. In other words, big companies that are growing and emerging companies that are growing, mutual funds, you get some diversification there. Blue chips are major companies. Again, their stocks generally hold their value even during volatile times, and generally the trend on those is up. They're not going to gain a ton of value because they're not really companies that are likely to grow. There is something we refer to as the efficient market hypothesis that generally all stocks are valued about where they should be. And so most blue chip stocks generally are very steady, which means they're not going to deliver a huge rate of return, but they are going to be fairly good. They're going to give you a little bit more return than those low-risk investments because there's a little more market risk involved in the stock market. Some bonds, real estate, and we'll talk about REITs, real estate investment trust. You don't necessarily have to buy a house or an apartment building to invest in real estate. You can kind of pool your money with others, and REIT is kind of like a mutual fund that invests in real estate instead of stocks and bonds. And so the one thing about intermediate risk tier 2 assessments, they have a little bit greater default risk. There's some market risk, especially with the stocks and the real estate, and there's a little bit of inflation risk with the bonds as well. Tier 3, that's really high risk stuff. And again, unless you're really a market savant, you're probably not going to be getting involved in foreign stocks. Currencies, buying currencies is really volatile. Commodities, same thing. It's buying corn and soybeans and futures, oil futures, things like that. Those can be very, very volatile. Derivatives, these are very complex transactions. They can make you a lot of money, but they can lose you a lot of money. There's a lot of market risk in these. So that should be the smallest percentage of your investments, and you should have a financial advisor making those investments for you. If you have anybody making those investments. Most of us are pretty comfortable at tier 2. The upper part of tier 2, maybe not quite so much. Most of us not very comfortable at tier 3, but go up as high on the pyramid as you feel comfortable. Right now, you're probably going to want to be at the base and maybe tier 1 in the early family life stage. And then as you gain more income, build your emergency fund, can take on more risk, you can bump up. But a lot of us, again, this is going to be done in mutual funds. Diversification of assets is key. Why do you want to diversify? You don't want to put all your eggs in one basket, because what happens when you drop the basket? All the eggs break, right? If you have a bunch of eggs in a bunch of different baskets, if you drop one basket, well, okay, that egg breaks, but the other eggs are all fine. And it's the same thing when you talk about investing, that, okay, if everything's in stocks, well, right now you're taking a bath because the stock market is absolutely plummeting right now. But if you've got a little bit in stocks and a little bit of bonds and a little bit in foreign stocks and a little bit in municipal bonds, a little bit in U.S. Treasury bonds, a little bit in corporate bonds, a little bit in growth stocks, a little bit in value stocks, a little bit in blue chip companies, those aren't all going to plummet at the same time. Some will plummet, some will hold steady. But on the flip side, some will grow while some will hold steady during good times. So when you diversify, you essentially mitigate your risk and decrease your default risk, decrease your market risk. All those levels of risk are decreased the more diverse your portfolio is. And so we'll build a portfolio. We're going to start with stocks over the next week, but we're going to build a portfolio. Mutual funds are a good way to diversify, and that's going to be the thing we look at next week is mutual funds, because what mutual funds are is where you pool your money and essentially pay a fund manager to buy stocks and bonds and other investments, some commodities or whatever, usually stocks and bonds, on your behalf. And there are mutual funds that are directed towards certain things. So there are some mutual funds that only invest in growth stocks, emerging and growing companies. Some that only invest in blue chip companies. Those are fairly safe. Some that only invest in bonds. Some that do a little bit of everything. And so one thing you can do is put your money in a few different mutual funds. And again, generally your retirement account will do this for you. And your 401k, or if you're a public employee, they call it a 403b, it's the same thing. But your retirement account will largely do this for you. And so that's something to kind of think about. And use the financial advisors that your company gives you and gives you access to that manage your retirement accounts, and talk to them. And about every 6 months to a year, evaluate your portfolio, try to maintain balance and rebalance. And again, talk to your financial advisor. And again, if you have a retirement fund through your employer, that's going to be your financial advisor. Talk to that person and have them help you keep your portfolio balanced. Finally, let's look at the life stages. The independent life stage, which is where you are right now, maybe build a 529 account. A 529 is a college savings plan. Or start building a retirement account. And again, there's two types of retirement accounts, and we'll talk about those a little bit later. One of them is the traditional IRA. That reduces your tax burden right now. The other is the Roth IRA, which is paid for right now out of after-tax income, but when you withdraw your money at the end, after you turn 58 and a half years old, you don't pay taxes on that. And so they both have their advantages. I kind of tilt toward recommending the Roth if you're going to start one, because again, it's after-tax income, and so you don't pay taxes in the back end. And so something you might want to think about if you stop by your bank or stop by Edward Jones and see how little money you have to start a Roth IRA. In the early family life stage, which again, when you graduate from school, get your first full-time job, this is the early family life stage. And that basically continues until your last kid has has moved out of the house, started college, or moved to work their first full-time job. You want to keep contributing. Build IRAs, individual retirement accounts, your 401k, which is your retirement account through your employer. Keep contributing to those. If your employer gives you a 401k, invest in it. If they give you a match, absolutely pay up to the match, and then maybe some more. So, for example, if they match 50 cents on the dollar up to 5%, put 5% in, because they're going to give you 2.5% of your salary for free. And so don't turn that down. 401ks use pre-tax income, so it lowers your income for tax purposes. And the flip side is that after you turn 58 and a half and can start withdrawing, you do have to pay taxes when you withdraw the money at the end. If you have kids, establish a 529 plan for their college savings. I think that's going to be key. The empty nest life stage. Once your kids start college, you're going to start withdrawing from those 529 plans. And by the way, getting those 529s is absolutely vital. College is not cheap, and it's not going to get any cheaper. So start withdrawing when your kids are in school, and then continue to contribute to your retirement accounts until you retire. And try to, especially when you get into your prime earning years in your 40s and 50s, put as much as you can in. Obviously, that's a long way away, but the more you put in, the better off you're going to be. Time is your best friend when it comes to a retirement account, but obviously the more money you're making, the more disposable income you have, the more you want to set aside, because the more you have set aside, the more options you give yourself. And then in retirement, enjoy those savings. Enjoy the nest egg you've spent the previous 30, 40 years building up, and enjoy those retirement savings. Start withdrawing from your 401k or your IRA or your Roth IRA, and all that money you've set aside in mutual funds and stocks and bonds and real estate and the other things we're going to be discussing over the next few weeks. Enjoy it because it's there for you. The next thing we're going to have is our stock project. I'm going to discuss that next week, but take a look at Canvas. There's a couple of assignments in there for you that really just help walk you through how to look at saving and different types of savings, and then different types of investments as well in the investment pyramid. So check Canvas for those assignments. Hope you've enjoyed the last few minutes of our conversation. And as always, if you need to get a hold of me, I'm always an email away.